Good evening and welcome to another episode of Night Markets, where each week I'll be giving you my perspective on what's driving markets, as well as my point of view as a family office professional. My name is Jacobus Brink, the Chief Investment Officer and Head of Investment Research at SFO. So during the course of the week, despite the market's gains remaining very narrow, the S&P 500 continued to ascend to record highs. Growth shares outperformed their value counterparts by about 4.1%, as measured by the Russell 1000 indices, while the small and mid-cap benchmarks experienced losses for the week. With the US markets being closed on Thursday in observance of the Independence Day holiday, trading volumes were reduced during the week, so this could also have had a bit of an influence on the market. So before we get into the detail around what happened in markets, let's just have a look at what the current situation is in the Middle East. So during the course of the week, two Hamas officials stated that they are awaiting a response from Israel regarding their ceasefire proposal. The announcement was made 5 days after Hamas accepted a critical component of a US plan to conclude the 9-month conflict in Gaza. Qatar and Egypt are serving as intermediaries in the three-phase strategy that was proposed by President Joe Biden at the end of May. Its objective is to conclude the conflict and liberate the approximately 120 Israeli captives who are currently being held by Hamas. The timeline of Israel's deliberations, however, was not immediately addressed by the government, and Hamas has relinquished its demand that Israel establish a permanent ceasefire prior to the signing of an agreement. So rather, it stated that it would permit negotiations to accomplish this during the initial 6-week phase. William Burns, the director of the U.S. Central Intelligence Agency, will also be traveling to Qatar for the negotiations during the week. So getting into the detail around the markets, let's start with the Americas. The week kicked off on a bit of a shaky footing as the Institute for Supply Management reported its lowest manufacturing activity reading of 48.5 since February on Monday. Additionally, it also revealed an unexpected decrease in construction activity. But perhaps even more unexpected was the significant decline in the ISM's measure of current services sector activity, which was released on Wednesday. The index plummeted from 53.8 in May to 48.8 in June, and this actually also signaled its lowest level since shortly after the commencement of the pandemic lockdowns in early 2020. Respondents noted that high gas prices and concerns regarding the inflated prices of restaurant menus were weighing on consumer sentiment. In the same vein, the employment data of the previous week provided conflicting evidence regarding the economy's health. The Labour Department's JOLTS report, which was released on Tuesday, indicated that job openings increased slightly to 8.14 million in May. However, this was a minor increase from the downwardly revised 7.9 million in April, which was the lowest level in over 3 years. Similarly, ADP, a payroll processor, reported that the number of private sector job growth decreased from 160,000 in May to 150,000 in June, which was also lower than anticipated. The highlight of the week, however, was Friday's release of the Labour Department's official employment report, which confirmed a slowdown in job growth, with June job gains decreasing to 206,000. The decrease was less than the consensus expectations. However, it is important to note that a rise in healthcare employment and an increase in government positions helped offset the weakness in private sector hiring. Employment at hotels, restaurants, and retailers experienced a slight decline, which may suggest a lack of discretionary spending from consumers. The good news, however, was there was some evidence of decreasing inflationary pressures, which were the only real positive aspect out of the sluggish economic readings. The ISM data indicated that growth of input prices for both services providers and manufacturers was also slowing down, which alleviated some of the recent upward pressure in both sectors. Additionally, Fed Chair Jerome Powell's reassuring remarks at a European banking conference on Tuesday also seemed to dispel some of the investor fears. He did acknowledge that the Fed had made a bit of progress in bringing inflation lower, despite the fact that it was unlikely to reach the Fed's 2% target until late 2025 or even into 2026. The week's economic data and Chairman Powell's remarks appear to be the driving factors behind the decrease in long-term U.S. Treasury yields as markets started pricing in the possibility of earlier rate cuts in the U.S. However, activity in the bond market was generally low during the holiday-shortened week. So despite the relatively weak and somewhat conflicting data, the S&P 500 and the Dow Jones Industrial Average rallied by 1.5% and 0.5% respectively, while the tech-heavy Nasdaq ended significantly higher, gaining 3.02%, mostly on the back of the fact that we saw some drop in U.S. Treasury yields. The Nasdaq Composite has now ended the week 73.71% above its lows since the market began its rebound in mid to late 2022. However, in contrast, and as an indication of how weak the breadth currently is in the market, the Dow Jones Industrial Average, which is more value-orientated and narrowly focused, has gained less than half of that percentage at 32.79%. And then moving across the Atlantic to the Eurozone and the UK, the week once again started on a bit of a shaky footing as increased political uncertainty in the EU following the first round of the French parliamentary elections, in which Marine Le Pen's far-right national rally gained the largest share of the vote. This resulted in significant losses for President Emmanuel Macron's ensemble, which placed third behind the left-wing New Popular Front. Political jitters did, however, ease as the far right in France failed to win an outright majority in the first round of legislative elections. Additionally, Christine Lagarde, the president of the European Central Bank, appeared to adopt a slightly more hawkish stance during her speech at the central bank's annual retreat in Portugal. She indicated that Europe is still faced with numerous uncertainties regarding the future impact of inflation, particularly in relation to the evolution of the nexus of profits, wages, and productivity, as well as the potential for new supply-side shocks that could possibly affect the economy. In addition, she also stated that it will require some time to accumulate an adequate amount of data to confirm that the risks of inflation exceeding the target have actually been mitigated. Further to this, the minutes of the European Central Bank's June meeting also indicated that certain members were opposed to the first rate reduction since 2019, citing the fact that wage growth had exceeded expectations and inflation appeared to be more persistent. A final estimate of Eurozone inflation during the week confirmed that the year-over-year change in consumer prices decreased 2.5% in June. Nevertheless, a critical service component remains stubbornly elevated, which likely bolstered the ECB's argument for extra caution. In further political news out of the UK, the Labour Party emerged victorious with a large majority in the general election, concluding a 14-year period of turbulent Conservative rule. Interestingly, this will also see the appointment of the country's inaugural female Chancellor of the Exchequer. And then just looking at the market performances, in local currency terms, the Pan-European Stocks Europe 600 index ended about 1% higher, with the outperformance there being from France, which ended 2.62% higher. And then moving further east to the Asia-Pacific region, starting in Japan, the Nikkei 225 index gained 3.36%, and the broader Topix index also advanced 2.65%, as Japan's stock market hit an all-time high during the week. The gains were driven in part by the yen's weakness, which is typically a tailwind for export-focused industries. According to data from Japan's largest union organization, its members experienced the largest wage increase in 33 years with an average increase of 5.1%. The final figure, which encompassed a greater number of small businesses, was lower than the initial estimate of a 5.28% wage increase. However, it still underscored the robust upward trend in wages, which could be a problem for inflation going forward. In May, household expenditure experienced a 1.8% year-over-year decline, which was significantly lower than the consensus estimate of 0.1% increase in outlays. Additionally, consumer expenditure decreased by 0.3% on a sequential basis, in contrast to the anticipated 0.5% increase in the month-over-month trend. The yen's continued weakness appeared to hinder spending, particularly the demand for overseas excursions. In contrast, the increase in prices resulted in a 3.1% decrease in food expenditure in comparison to the previous year. And in some negative news, the initial 3-month revision of Japan's GDP number indicated that the economy actually experienced a 2.9% year-over-year contraction, which was more severe than the initial estimate of 1.8%. The third and fourth quarters of 2023 numbers were also revised downward. The yield on Japan's 10-year sovereign bond climbed to about 1.1%, its highest level since 2011, before easing somewhat on the back of lower US Treasury yields later in the week. And then moving on, China, government data indicated that the world's second largest economy's manufacturing sector experienced a second consecutive month of contraction in June. June's official PMI numbers came in at 49.5, which was identical to May, as new orders and exports decreased. The non-manufacturing PMI, which gauges construction and services activity, increased to 50.5, below expectations, and also a decrease from 51.1 in May. Separately, the private S&P Global Survey of Manufacturing Activity increased to 51.8 in June, surpassing the expectation of 51.7 and actually marking its 8th consecutive monthly expansion. So we can see the uneven performance of China's economy this year being reflected in the mixed PMI readings. It's also been influenced by the 4-year-long property decline that has impacted domestic consumption, as well as escalating trade tensions that threaten the manufacturing sector. In real estate news, the China Real Estate Information Corporation reported that the value of new home sales by the country's top 100 developers decreased by 17% in June compared to the previous year, a decrease that was less severe than the 34% decline we did see in May. The data raised expectation that China's housing market, which is currently experiencing a 4th year of decline, could begin to recover following the government's announcement of a comprehensive rescue package in May. And looking at market performances, the Shanghai Composite Index as well as the blue chip CSI 300 Index both registered modest losses for the week. And in Hong Kong, the benchmark Hang Seng Index gained 0.46% during a holiday-shortened week. And then bringing it back home in another week, mostly dominated by local politics, markets welcomed the reappointment of Finance Minister Enoch Godongwana in the new coalition cabinet unveiled by the president. Investors who had expressed apprehension regarding the nature of the coalition that would emerge subsequent to the May elections seem to have also been reassured by the establishment of the Government of National Unity. The new cabinet is now required to collaborate in order to advance the interests of all South Africans. And although the verdict is still out on the potential success of the new form of government, the market seems to be optimistic. The president emphasized that professionalization of the public services as a shared priority of the new Government of National Unity. Additionally, he also indicated that all parties have consented to prioritize the development of sustainable and inclusive economic growth for the country. And then just looking at the performance of the local market, on the back of a relatively positive week from a sentiment point of view, the JSE All-Share Index ended the week higher by 1.37%, as the resources sector saw a jump of almost 5% on the back of a weaker US dollar and higher commodity prices. The Rand also ended the week slightly higher at 18.13 to the US dollar after initially selling off earlier in the week on some political uncertainties. Then just looking at the week ahead in the US, Chairman Jerome Powell will also address the Senate Banking Committee in advance of a critical CPI report that is scheduled to be released on Thursday. Both these events have the capacity to influence policy expectations for 2025, so investors will keep a keen eye on it. Investors' expectations that the US stock market rally will extend beyond mega caps will also be put to the test in the upcoming weeks as they determine whether profit growth from other companies are actually beginning to surpass that of the tech-related leaders. And on the local side, as the political situation has now mostly been digested by markets, the focus will be on the manufacturing production numbers out on Thursday. And then, as always, an interesting investment discussion we had during the week was whether the very strong rally in AI stocks could be reaching a tipping point. The top 10 companies of the S&P currently make up 35% of the market cap, but only contribute 23% of the earnings. This divergence has actually never been bigger, suggesting that the market is record bullish on future earnings for the top 10 companies, which are mostly tech-related. In addition to this, the 3-month rolling correlation between the S&P returns and the number of advances is at an all-time low. The only period remotely resembling this kind of level that we're seeing now came in the third quarter of 2000, which was obviously the start of the deflation in the tech bubble. So this just means that there's little fundamental evidence to actually suggest that the reality of the earnings will live up to the hype around big tech that we are currently seeing in the market. Thanks for joining me for another episode of Night Markets. Financial markets close at 5 p.m. Night markets open at 6 p.m. Let's start the conversation.